It's for those of you who are looking for a place to put your safe money, your rainy day money. Could be money you have in CDs, could be in a money market account someplace, a savings account someplace. You don't need the money over the next few years. And so you're thinking, where can I put this money? I'm kind of frustrated with the banks because I'm not earning any interest. So what can I do? Um, and you don't want to put in the stock market. Has nothing to do with the stock market. Don't even think about the stock market. This is safe money. So in this particular scenario, we're going to show you what we refer to as dividend paying whole life insurance. Now, I know you've heard that whole life insurance is a horrible place to put money. Well, you're going to see the facts, and then you can make up your mind. So in this scenario, this 55-year-old male has $100,000 and he puts it in his. We're going to do an illustration to see if he wants to put it in his policy. So when he does, he goes to work in the first couple years, and he's a little underwater, but very quickly he comes out of there, and by the end of the fifth year, he's at 114,932. Well, we're going to compare that with CDs, taxable bonds, and tax-exempt bonds. These rates of return, 1.46% on the CD. It's based on Bankrate.com. At the end of 2012, this is taxable bond, and this tax-exempt bond based on yields that were published in Bloomberg.com towards the end of 2012, 3.3% on taxable and 2.6 on a 20-year tax-exempt bond. So let's look at it. 114,932, basically 115,000. There's 105,368 in the CD, 112,458 in a taxable bond, and 113,694. So you can see the whole life policy did quite a bit better. But the interesting thing here, as the years go by, this policy gets more and more efficient. So you see in year 10, we're up to $150,000 in cash. When you look at the CD, you're at 111, 126,468 in a taxable bond, and 129,263 in a tax exempt bond. Let's take it out 15 years. You've almost doubled your money here. You're at 196,468 in the whole life policy, 116,983 in the CD, and 142,224 in the taxable bond, 146,964 in the tax exempt bond. You can see the whole life policy just basically leaves these other forms of safe money in the dust. Here's another very cool thing to consider. All this money you're making here, you don't pay a dime of tax on it until you use it. It's tax deferred. Over here, every single year in the CD and this taxable bond, the IRS is going to get a notice that you've made some money and now you get to pay taxes on it. And between taxes and inflation, you're not going to make very much money at all. Over here, it's tax deferred. It just grows even more. Another very significant aspect of this is that since it's a life insurance policy, obviously it's got to pay a death benefit, right? So in your first year, you put your $100,000 in this thing, and you guess what? You get in an accident, your family gets 273,344. Well, it's probably not likely you're going to die the next year, but let's say this 55-year-old lives to he's 65, he's getting ready to retire, and something happens to him and passes on. Well, there's $150,000 of cash in this policy, but guess what? His family gets $275,514 tax free and probate free. In the CD, your family gets what's in there, 111,000, and if it's this CD wasn't set up right, that money ends up in probate court. Same with this bond and the tax exempt bond. You get what's in there, and it could end up in probate court. Another cool thing in most states, this money here is protected from creditors. Pretty cool. So just right here, you're thinking, wow, I make a whole lot more money here, and if I die, I leave a great legacy to my family, and it's probate free and tax free. But let me show you why this thing does so well. Take you to another page. And you'll see that when you dump in this $100,000 in this particular scenario, 1,420 went into paying a $50,000 death benefit. You got to do that to meet the IRS rules. The rest, 98,580, goes into what we call the paid up additions or paid up additional life insurance. So that's why you end up with this death benefit of 273. Now, once that extra death benefit is paid, you're done. This 98,000 continues to make money from here on out, no fees, no cost. It earns dividends and interest. That is used to buy more paid up insurance. After that's paid for, it's done and it's cash from there on out. It really becomes a cash machine. So your death benefit you see goes up and up and up every year. It's all paid for. But in this particular scenario, it is based on you paying this 1420 every year. But we don't want to do that. So in this scenario, the dividends and the interest pay for the 1420. You never pay another dime premium outlay. You never pay any more money. The cash value goes up. The death benefit goes up. This death benefit is completely paid for. It's done. 10 years down the road, you don't want this policy anymore. I don't know why you would want to terminate it, but you do. You walk with your 150. You're done. This is all paid for. So going back to the original page and to wrap it up, look, folks, there are a lot of places where you can put your safe money, even on the mattress if you want. But if you don't need the money right away and you want a good, solid place to put your money, safe for the future, accessible anytime you need it, you might want to look at a whole life policy because it's going to create great cash for you. It's going to grow tax deferred, so you're not hit with a tax bill every year. And if you die before you use the money, guess what? Your family gets a huge death benefit, tax-free and probate-free. All advantages that far outweigh these other alternatives. So again, if you're looking for a place for safe money, consider whole life dividend paying policies with a mutual company like this because you will be a part owner of the company. It's a great alternative. If you need any extra information, let me know, and I hope this has been informative for you.